Hello viewers, so welcome to my channel. I'm Hashim Ali Khan. So now I'm going to start the next problem. Problem number 14 on accounts from incomplete records. So presently I'm discussing about the topic accounts from incomplete records. Commonly it is known as single entry system. So what is the system? I have already explained in the first introduction video. Hope you have watched that one. Actually it is not a full-fledged accounting system. That's why its name is incomplete records. Only petty businessmen, the small sole trading businessmen, they may follow this method. Not a full-fledged method. No trading profit and loss account can be prepared, no balance sheet can be prepared because there are no nominal accounts, real accounts are maintained. Only personal accounts are maintained. That's why. So how to find out the profit? There is some procedure. Calculate the capital in the beginning, capital at the end, make a statement to find out the profit. So already in the last so many problems, 13 main problems and 12 short problems I have completed. Hope my regular viewers have already watched those problems. Now you are in a better position to answer, to attempt the problem on single entry. If you have not watched the earlier problems, I suggest you to go to the playlist of my channel. Select the subject Financial Accounting 2. In that you will find the videos of accounts from incomplete records. So watch the first introduction part. You can be able to know what are the complications, what are the issues in accounts from incomplete records. Normally in examination, a theory question may also be asked regarding what are the features of single entry system and what are the differences between single entry system and double entry system, how profit can be ascertained, what is statement of affairs. All these things I have explained in the first video. So watch the initial videos, you will get a good grip on this topic of single entry system. Then you watch this video. Now before starting the 14th problem, I expect my viewers to have a printout of the problems which I have given in the link under my description. So take a printout, keep it ready and start watching the problems. 14th one. See carefully. The following is the statement of affairs as at 31st March 2005 of Young and Bell. The two partners are there, Young and Bell, who were in partnership sharing profits and losses in the proportion of 2/3 and 1/3 respectively. So profit sharing ratio 2/3, 1/3. From the particulars given below, prepare as at 31st March 2006 and a statement of profit and apportioning the balance between Young and Bell and a statement of affairs as at that date. So it is specifically asking you to prepare a statement showing how much profit or loss earned or incurred during the year and distribute it between the partners. And secondly, it is asking you to make a statement of affairs at the end of the year. For the year ended 31st March 2006. Now Young and Bell, statement of affairs as at 31st March 2005. Beginning of the year statement of affairs is given. Only we have to make at the end of the year. The beginning of the year, capital accounts Young 20,000, Bell 8,000, total 28,000 combined capital. Then bills payable, sundry creditors, liabilities over, asset side, plant and machinery, freehold property, furniture fitting, stock, debtors, bills receivable, bank, cash, assets. The opening balance sheet given. Now the position as at 31st March 2006 was as follows. End of the year. Cash at bank 1500, cash in hand 100, sundry creditors 19,000, bills payable 1200, sundry debtors 5,000, bills receivable 3,800, stock on hand amounted to 8,400. All the assets and liabilities at the end of the year are given, so we can make the statement of affairs at the end of the year. Now, Young's drawings during the year had been rupees 3,000 and Bell had drawn 1,200 rupees. Drawings are given. That means cash withdrawn by the owner, by the partner for personal use. That is called drawings. So Young's drawings are 3,000 and Bell's drawings are 1,200. Young withdrew the sum of rupees 4,000 on 30th September 2005 from his capital account. So apart from the drawings, Young, the first partner, has withdrawn 4,000 rupees from his capital. That is also drawings. The regular drawings are 3,000. Apart from that, he has withdrawn 4,000 rupees from his capital. And the date is also given on 30th September. That means initially at the beginning of the year, his total capital was 20,000. 20,000 was the capital at the beginning of the year. So after 6 months, means April, May, June, July, August, September. April, May, June, July, August, September. These 6 months he was having 20,000 rupees as capital. Remaining 6 months he was having only 16,000 capital because 4,000 rupees Young has withdrawn from his capital. Now, depreciate machinery and plant by 5%, furniture fitting by 10%, and allow interest on capital at the rate of 5% per annum. Ignore interest on drawings. So we have to calculate interest on capital. The adjustments are regarding depreciation and regarding interest on capital. That's it. So it's very easy problem. First of all, we have to make a statement of affairs at the end of the year, 31st March 2006. Statement of affairs on 31st March 2006 without any adjustments. We have not made any adjustment. No interest on capital, no depreciation. Without adjustment, cash in hand, cash at bank, debtors, bills receivable, stock, freehold property, plant and machinery, furniture. All these are the values which are given in the problem. See here, the freehold property, plant and machinery, furniture, whatever is there in the beginning of the year, same I have taken at the end of the year. Same, because there is neither purchase nor sale of any fixed asset. Fixed assets are same. The beginning of the year, freehold property 12,000, end of the year also. Beginning of the year, plant and machinery 4,000, end of the year same. Furniture, beginning 1,000, end same. So total is 35,800 assets. Two liabilities are the creditors, bills payable. Deduct. 35,800 minus 19,000 minus 1,200. 15,600 is the combined capital. This is the combined capital of Young and Bell at the end of the year, 31st March 2006. Now we'll make the statement of affairs, no, not statement of affairs, statement of profit or loss. Statement of profit or loss for the year ended 31st March 2006. Now, combined capital on 31st March 2006, just now we have calculated 15,600. To this we have to add drawings. Drawings in the problem it is given. 3,000 rupees had been drawn by Young. 1,200 rupees are drawn by Bell. Apart from that, Young has withdrawn 4,000 rupees from his capital also. The total drawings 3,000 plus 1,200 plus 4,000, 8,200 are the total drawings. Add up 23,800 minus combined capital at the beginning of the year. Opening balance sheet is given in the problem. Opening balance sheet. The liability side you can see Young 20,000, Bell 8,000, 28,000 is the combined capital at the beginning of the year. 20. Deduct 28,000. So minus 4,200 loss. Because 23,800 minus 28,000 you are getting minus 4,200. This minus 4,200 is a loss before adjustment. Before adjustment loss we are getting. Now adjustment. Deduct. Interest on capital. Just now I told you Young. Beginning of the year Young was having 20,000 rupees capital. But this 20,000 was up to 30th September. Because on 30th September he has withdrawn 4,000 rupees from his capital. So 20,000 minus 4,000, 16,000. So Young's capital was 20,000 for 6 months and 16,000 for the next 6 months. So we calculate interest separately. 20,000 into 5% for 6 months. It is coming to 500. Remaining 6 months his capital was only 16,000 because 4,000 he has taken away. So 16,000 into 5% into 6 by 12, 400. So total interest on capital to Young is 900. Bell has capital of 8,000 rupees. At the beginning of the year, Bell's capital was 8,000 and Bell has not withdrawn anything from capital. From capital he has not drawn anything. So 8,000 into 5%, 400. So 900 interest on capital to Young and 400 interest on capital to Bell. Now depreciation on machinery. It is given in the problem 5%. 5% on plant and machinery. So plant and machinery, what is the value? 4,000. 4,000, 5%, 200. Depreciation on furniture. It is asking you to calculate 10%. So 10% of 1,000, 100. Take the total of all deductions, 1,600. Deduction 1,600. So already we are having minus 4,200. Again we have minus 1,600. Add up both 4,200 plus 1,600 minus 5,800. Minus 4,200 minus 1,600. You will get minus 5,800 loss. This is the net loss. Net loss is 5,800. Now this 5,800 will be divisible between the partners in the profit sharing ratio. What is the profit sharing ratio given in the problem? 2/3 and 1/3. 2/3 and 1/3. So 5,800 into 2/3, 3,867. This is the share of loss. Share of loss of Young. Similarly, share of loss of Bell. 5,800 into 1/3, 1,933. So the total loss 5,800 is divided between the two partners in the profit sharing ratio. That's it. We have completed the statement of profit or loss. Now we are required to make the statement of affairs. It is asking you to calculate the statement of affairs. Here also statement of affairs we have prepared, but without adjustment. Without adjustment we have prepared the statement of affairs. Now with the adjustment, what is the statement of affairs? See here, cash in hand, cash at bank, debtors, bills receivable, stock, no change. Because we have made the change only in machinery and furniture. Except machinery and furniture, all the assets, cash in hand, cash at bank, debtors, bills receivable, stock, freehold property, up to here the same values are taken here. Cash in hand, cash at bank, debtors, bills receivable, stock, freehold property. The only changes is depreciation is provided on machinery and on furniture. So machinery 4,000. How much depreciation? 200. So 4,000 minus 200, 3,800. Similarly, furniture, 1,000 rupees is the value of the furniture. How much depreciation? 100. So 1,000 minus 100, 900. That's all. Asset side completed, 35,500. Now come to liability side. On liability side, the two liabilities are there. That is creditors, bills payable. No change at all. Same. Creditors, bills payable, 19,200. Same. Now we have to take the capital accounts. Capital accounts one by one will take Young. Young's capital in the beginning of the year 20,000. 20,000 rupees is the capital of Young at the beginning of the year. From to this you add the interest on capital. How much interest on capital is allowed to Young? 900. 900 rupees is the interest on capital which is allowed to Young. So add 900, 20,900 minus net loss. How much is the share of loss of Young? 3,867. Profit will be added, loss will be deducted from capital. So this 3,867 is a loss. So it will be deducted minus 3,867 deduct 17,033. Drawings. Young has withdrawn 3,000 plus 4,000. 7,000 rupees here totally withdrawn. So deduct 7,000. Drawings 3,000 plus 4,000. The total capital of Young at the end of the year 10,033. After making all adjustments, the Young's capital at the end of the year 10,030. Bell. Beginning of the year capital of Bell was 8,000. To this we add interest on capital. So interest on capital 400 rupees already we have calculated here. Add up 8,400 minus net loss. What is the share of loss? 1,933. Deduct 1,933. 6,467. From that deduct the drawings. How much drawings Bell has taken? 1,200. 1,200 rupees is the drawings. Deduct 5,267 is the capital of Bell. Now take the total of liability side 35,500. The liability side, asset side, the total is same. That's all. So this is the end of problem number 14. Totally 14 problems we have completed. Come on. Now we'll start the next problem. Problem number 15. 15th problem is entirely different. Here we are not required to make any statement of affairs or statement of profit or loss. Here we have to ascertain how much are the credit sales, how much are the credit purchases. See the 15th problem carefully. Ascertain credit sales and credit purchases from the following figures. So some data is given and we have to find out the credit sales and credit purchases. Opening balances, debtors, creditors. Actually, these debtors and creditors are the old terms. According to new terminology, debtors are trade receivables and creditors are trade payables. Names have been changed, but the content is same. The logic is same. The debtor are the customers to whom we sold the goods and the amount is due from them. And creditors are the suppliers from whom we purchased the goods and amount we have to pay to them. So we have to pay the amount to creditors and we have to get the amount from the debtors, right? Come on. Here opening balances. So we, in order to find out the credit sales and credit purchases, we need two accounts, debtors account and creditors account. By making debtors account, we will get credit sales. And by making creditors account, we get credit purchases. Remember this. Now, opening balances. After making this account, first of all, we will take the opening and closing balances one by one. Remaining, you have to remember the entries. First of all, debtors is an asset. All assets will show debit balance. Creditor is a liability. All liabilities will show credit balance. Debtors will show debit balance. Creditors will show credit balance. So here debtors, to balance brought down. What is the opening balance? 11,400. So I have taken here 11,400. Opening debtors. Similarly, opening creditors. Opening creditors are 6,800. So credit side, by balance brought down, opening 6,300. We have taken the opening balance of debtors, opening balance of creditors. Now closing balance of debtors, closing balance of creditors, opposite side. Here opening balance we have taken on debit side, so closing balance will take it on the credit side. The last line you can see closing balance of debtors 10,800. So here I have taken by balance carried down 10,800. Similarly, closing balance of creditors 5,400. So I will take it on the debit side 5,400. Opening balance credit side, closing balance debit side. Here opening balance debit side, closing balance credit side, opposite. That's all. The opening and closing balances we have taken. Now one by one. Discount allowed. Here, when you are required to make the accounts, you must remember the journal entries. If you remember the journal entries, easily you can post it and prepare the accounts. So here discount allowed. So keep a notebook while watching this video. Take a notebook, pencil. As soon as I tell some entry, immediately you record it. You write down the entry. It will be easier for you to understand and prepare the accounts. So discount allowed entry will be discount allowed account debtor to debtors account. Discount allowed account debtor to debtors account. So debtors account should be credited by discount allowed. By discount allowed 1,500. See here. By discount allowed 1,500 I have taken on the credit side. What is the entry for discount allowed? Discount allowed account debtor to debtors account. So debtors is created by discount allowed. Next, sales return. The entry for sales return is sales return account debtor to debtors account. Sales return account debtor to debtors account. So debtor should be created by sales return. Here you can see by sales return 800. By sales return 800. Next, bills payable issued 3,100. Bills payable issued 3,100. Entry will be creditors account debtor to bills payable. Creditors account debtor to bills payable. So creditors should be debited to bills payable 3,100. 3,100. Next, cash received from debtors. Cash received from debtors 48,300. Entry will be cash account debtor to debtors account. Cash account debtor to debtors account. So debtors will be created by cash 48,300. See, for each one I am putting a tick. 48,300 cash received from debtors. Next, cash paid to creditors. Cash paid to creditors. So entry will be creditors account debtor to cash. Cash is going out. So cash should be created. So creditors account debtor to cash. So creditors should be debited to cash 25,100. Right? Next, bad debts written off. The entry for bad debts written off is bad debts account debtor to debtors account. Bad debts account debtor to debtors account. So debtors should be credited by bad debts. Here by bad debts 300. Right? Next one is discount received. We receive the discount from creditors. The entry will be creditors account debtor to discount received. Creditors account debtor to discount received. So creditors should be debited to discount received 300. Next, after discount receipt, purchase return. Purchase return. So entry will be creditors account debtor to purchase return. Creditors account debtor to purchase return. So creditors should be debited to purchase return 600. Then after purchase return, bills receivable received. Bills receivable received. So entry will be bills receivable account debtor to debtors account. Bills receivable are received. So bills receivable account debtor to debtors account. So debtors should be credited by bills receivable. So by bills receivable 6,100. Over closing balances. That's all. Closing balances already I told you. Opposite. Opening balance debit side, closing balance credit side. Here opening balance credit side, closing balance debit side. First of all we take the balances. Remaining all items we have taken. We have taken each and every item. We have taken whatever data is given in the problem. I told you the entries. You might have recorded. If you have not recorded, rewind the video. Again you watch the video. Each and every item I have explained the entry, journal entry. Which account is debited and which account is credited. If you remember the entries, you can prepare the accounts. Over. Now see here. Here, debit side, credit side. Credit side, you see all the values are ticked here. There is nothing, no value is unticked. All values are ticked. Take the total 67,800. Debit side, one ticked item is there. So 67,800 minus 11,400. The balancing figure is 56,400. This 56,400 is the sales. We sold the goods to debtors. Entry will be debtors account debtor to sales. Entry will be debtors account debtor to sales. So debtors should be debited to sales. Balancing figure 56,400. So one item we got credit sales 56,400. Answer. Now it is asking you credit purchases. Credit purchases, you see creditors account. Debit side you can see all the values are ticked. Take the total of debit side 34,500. From 34,500 deduct 6,800. 34,500 minus 6,800, 27,700 balancing figure. So this is the purchases. When goods are purchased, entry will be purchases account debtor to creditors account. We purchase the goods from creditors. We sell the goods to debtors. So when we purchase the goods from creditors, entry will be purchases account debtor to creditors. So creditors credit side by purchase, balancing figure 27,700. Over. The complete problem, it is asking you to calculate credit sales, credit purchase. Credit sales are 56,400, balancing figure. And credit purchases are 27,700, balancing figure. That's finished. This is the problem number 15. Now, see the 16th one. 16th also similar, but a little bit difficult because 4 accounts you have to make. From the following, prepare total debtors account, total creditors account, bills receivable account and bills payable account, and ascertain credit sales and credit purchases. So totally 4 accounts it is asking you to prepare. Total debtors account and bills receivable account, total creditors account and bills payable account. So see the board. Here I have prepared debtors account, here bills receivable account, creditors account, bills payable account. First of all, the balances are given. Balances on 1st January 2015, opening balance. Opening balance of debtors, creditors, bills receivable, bills payable. Similarly, last item you can see the closing balance. Closing balance of debtors, creditors, bills receivable, bills payable. So before recording all the other transactions, we take the opening and closing balances. Assets will show debit balance. Liabilities will show credit balance. You remember this point always. Debtor and bills receivable are assets. Creditor and bills payable are liabilities. So here assets will show debit balance. So opening balance of debtors. Debtors opening balance 18,000. So to balance brought down 18,000. One item I have taken. Now opening balance of bills receivable. Bills receivable opening balance 8,000. So to balance brought down opening 8,000. Both are assets. Both will be taken debit side to balance brought down. Now come to creditors. Opening creditors 12,000. Creditor is a liability. It will show credit balance. So credit side by balance brought down 12,000. I have taken opening creditors. Similarly, opening bills payable 7,000. Opening bills payable given 7,000. So by balance brought down opening 7,000. So I have taken opening balance of debtors, opening balance of bills receivable, opening balance of creditors, and opening balance of bills payable. That's it. Now closing balances, opposite side. When opening is taken on debit side, closing will be on credit side. If opening is on credit side, the closing will be on the debit side, opposite. The last one you see. Last one is total debtors at the end of the year. At the end of the year, the total debtors are 15,000. Closing debtors 15,000. So credit side, by balance carried down, closing 15,000. Similarly, closing creditors, total creditors closing 13,000. Here 13,000 creditors. Because opening we have taken on credit side, closing debit side. Now bills receivable closing 1,000. Bills receivable closing 1,000. By balance carried down, closing 1,000. Similarly, bills payable closing 6,000. Bills payable to balance carried down, closing 6,000. Over. So I have taken opening and closing. So debtors, opening balance 18,000, closing balance 15,000. Bills receivable opening 8,000, closing 1,000. Creditors, the creditors opening are 12,000, closing 13,000. Bills payable opening 7,000, closing 6,000. I have taken all the opening and closing balances. Now transactions. What are the transactions? See carefully. Here you need to remember the journal entries. So that's why keep a notebook ready. While I give the explanation, you immediately write down the entries, you can be able to understand. Otherwise it will be very difficult. Each and every transaction I am explaining the journal entry. First of all, bills receivable received during the year 20,000. Bills receivable received. So entry will be bills receivable account debtor to debtors. Bills receivable account debtor to debtors. So bills receivable should be debited. Here bills receivable is debited 20,000. And debtors should be credited by bills receivable 20,000. So bills receivable should be debited and debtors should be credited. The bills receivable debit side to debtors and debtors credit side by bills receivable 20,000. First transaction over. Second transaction, cash received from debtors. Cash received from debtors. Entry will be cash account debtor to debtors. Cash account debtor to debtors. So debtors should be credited by cash. By cash 35,000. By cash received 35,000. Next item. Cash paid to customers. Customers are the debtors. Customers are the debtors. So cash paid to debtors. So entry will be debtors account debtor to cash. Debtors account debtor to cash 1,000. So debtors debit side to cash 1,000. Over. Next one. Discount allowed to debtors. Discount allowed is a loss. It will be debited. Discount allowed account debtor to debtors. So debtors should be credited by discount allowed 3,000. By discount allowed 3,000. Next item. Allowances given to customers. Allowances given to customers. Customers are the debtors. So allowances account debtor to debtors. Because we are giving the allowance, it is a loss to us. So allowances should be debited. To whom we are giving the allowance? To the debtors, to the customers. Customers means debtors. So allowances account debtor to debtors. So credit side by allowances given 2,000. Next comes bad debts written off. Bad debts written off. So entry will be bad debts account debtor to debtors. Bad debts account debtor to debtors. So bad debts 4,000. Next comes bills receivable endorsed to creditors. Bills receivable endorsed to creditors. So entry will be creditors account debtor to bills receivable. Creditors account debtor to bills receivable. So creditors debit side to bills receivable 5,000. And bills receivable credit side by creditors 5,000. Here I have written by bills receivable endorsed. Here also bills receivable endorsed, 5,000. Bills receivable dishonored by customers. Bills receivable dishonored by customers. So entry will be debtors account debtor to bills receivable. Debtors account debtor to bills receivable, 6,000. Debtors debit side to bills receivable dishonored, 6,000. And bills receivable credit side by debtors bills receivable dishonored. 6,000 rupees debtors is debited and 6,000 rupees bills receivable credited for dishonored. Next, bills receivable honored by customers. Bills receivable honored by customers. That means we have received the cash on bills receivable. So entry will be cash account debtor to bills receivable. Cash account debtor to bills receivable, 14,000. So bills receivable should be created by cash, 14,000. Over. Next, interest charged to customers. Customers are the debtors. Interest charged, we are charging the interest. So interest is an income. So entry will be debtors account debtor to interest. So debtors account debit side to interest, 2,000. Right? Next, bills receivable discounted for 1,960, discount charges 40. Actually, we are having 2,000 rupees bills receivable and we have discounted this bills receivable with the banker. So entry will be bank account debtor, discount account debtor to bills receivable. Bills receivable is going out 2,000 and we are getting in bank 1,960 and we are allowing discount 40. So entry will be bank account debtor 1960, discount account debtor 40 to bills receivable 2,000. The bills receivable credit side by cash, by bank 1960 and by discount 40. So when we discount the bill, the entry will be bank account debtor 1,960, discount account debtor 40 to bills receivable 2,000. If you add up 1960 plus 40, 2,000, the bill is going out. The bills receivable should be created by bank, by discount. Next, after that, bills receivable discount dishonored. The bills receivable which was discounted, now dishonored. Dishonored means we have to reverse back the entry. Reverse back the entry. From whom we have received the bill? From debtors. So we debit debtors. Debtors account debtor to bank. Debtors account debtor to bank. We have to pay to bank because already this bill was discounted. Earlier we have discounted the bill with the bank. Now the banker is informing that the bill is dishonored. Now we'll collect the amount from debtors. So debtors account debtor to bank here. Debtors account debtor to bank 1,000. Bills receivable discounted dishonored. Next one, bad debts recovered. This entry will not come. Because bad debts recovered, the entry will be cash account debtor to bad debts recovered. So in this entry, debtors will not appear. So entry bad debts account debtor to, cash account debtor to bad debts recovered account. So this entry will not come. Next, sales return. Entry will be sales return account debtor to debtors. Sales return account debtor to debtors. So debtors will be created by sales return, 3,000. Next is bills payable issued during the year. Bills payable issued during the year. So entry will be creditors account debtor to bills payable. Creditors account debtor to bills payable. So creditors account debit side to bills payable. Bills payable account credit side by creditors 10,000. 10,000 rupees bill has been issued to the creditors. So creditors account debtor to bills payable. So creditors account debit side to bills payable 10,000. Bills payable credit side by creditors 10,000. Next comes cash paid to creditors. Cash paid to creditors. Creditors account debtor to cash. So creditors debit side to cash. 30,000 cash paid. Now discount allowed by suppliers. Discount allowed by suppliers. Suppliers are the creditors. Creditors are allowing us discount. So we are receiving the discount. We are receiving the discount. So entry will be creditors account data to discount received. Creditors account data to discount received, because creditors are allowing us discount. So creditors debit side to discount received 3000. Next comes allowances received from creditors. These allowances are received from creditors. So this allowance is an income. So allowance will be credited. So entry will be creditors account data to allowances. Creditors account data to allowances. So creditors debit side to allowances received 1000. Next comes bills receivable endorsed to creditors dishonored. Bills receivable we have received from debtors, and those bills we have endorsed to creditors. Now creditors are informing us that the bill was dishonored. Now we have to get the money from debtors and we have to pay the money to the creditors. So entry will be debtors account debtor to creditors. Again I repeat, we have received the bill from debtors and we have endorsed, we have endorsed this bill to the creditors. Now on the due date, the creditors are informing us that the bill which I have given is dishonored. Now I have to recover that amount from the debtor and I have to pay the amount to the creditor. So entry will be debtors account debtor to creditors. So debtors को debit करेंगे to creditors. To creditors 2000. And creditors should be credited by debtors 2000. Debtors should be debited, creditors should be credited, because the bill which we have given to creditors are dishonored. Next entry. Next entry will be bills payable honored. Bills payable honored, that means we have paid the amount. We have paid the amount on bills payable. Entry will be bills payable account debtor to cash. So here bills payable account debtor to cash. Cash paid 8000. Then bills payable dishonored. Bills payable dishonored. So entry will be bills payable dishonored. The entry will be bills payable account debtor to creditors. Bills payable account debtor to creditors. How much? 3000. So bills payable debit side to creditors 3000 and creditors by bills payable 3000. Bill dishonored. Next entry. Purchase return. Purchase return. So entry will be creditors account debtor to purchase return. Creditors account debtor to purchase return. So creditors debit side to purchase return 2000. Last one, next one is provision for doubtful debts. This provision for doubtful debts entry will be profit and loss account debtor to provision for doubtful debts. Profit and loss account debtor to provision for doubtful debts. This entry will not come in debtors, bills receivable, creditors, bills payable. So leave this entry. So out of the total transaction, 2 entries we are not recording. The 2 entries are bad debts recovered, that will not come here. Entry will be cash account debtor to bad debts recovered account. Second entry, provision for doubtful debts. Entry will be profit and loss account debtor to provision for doubtful debts. This entry will not come in debtors account, creditors account or bills receivable, bills payable. Over. All the transactions I have explained you, each and every transaction. Now we will see what is the balancing figure in each of the account. So here in bills here bills receivable account, you see the credit side, debit side you see 8000, 20000, 28000. Here 5000 ticked, 6000 ticked, 14000 ticked, 1960 ticked, 40 ticked, 1000 ticked. So no balancing figure at all. There is no balancing figure in bills receivable, both sides equal. Now debtors account. Debtors account you can see here, credit side all the values are ticked. So take the total of the credit side 82,000. From 82,000 minus 18,000 minus 1,000 minus 6,000 minus 2,000 minus 1,000 minus 2,000. The balancing figure is 52,000. This balancing figure 52,000 is the sales, credit sales. Finished. It is asking you to calculate cash sales and credit sales. I got credit sales 52,000. Balancing figure 52,000 sales. Similarly, bills payable account. You can see the bills payable account 8,000 ticked, 3,000 ticked, 6,000 ticked. So debit side 17,000. Credit side 7,000 ticked, 10,000 ticked, 17,000. The bills payable account is closed, no balance. Now come to creditors. Creditors account debit side, you can see all the values are ticked. Take the total of all the debit side, 64,000. From 64,000 minus 12,000 minus 2,000 minus 3,000. So 47,000 is the balancing figure, and that is the credit purchases. The purchases we can get from creditors, sales we can get from debtors, provided you must remember all the journal entries. That's all. So we got credit purchases 47,000 and credit sales 52,000. That's all. This is the end of problem number 16. So these two problems are entirely different. First time itself you may not be able to understand. Watch the video 2-3 times. Definitely you can be able to understand. These are no doubt difficult, but the thing is, these entries are very, very important foundation for accounting profession. Okay, we'll continue the next problem in the next video.